Hello there. Now, over the past couple of weeks, we've seen quite a strong bounce in markets. And the catalyst for that was essentially some of the inflation figures that came out, in particular in the US, but also here in the UK, which were just slightly better than expected. In fact, they were only 0.1 better than expected. But this added to the sort of evidence that we've started to see that inflation is falling, and hopefully it should continue to do so. We've also seen central banks decide to keep interest rates on hold, and some evidence that the economy is starting to slow just a little bit, and all of that has kind of added to the confidence that investors have that inflation's on the way down, interest rates have stopped going up. Now, as you'll know if you've read our quarterly report or seen some of our recent videos, we strongly believe that what's happened over the past couple of years in markets where lots of different assets have fallen all at the same time has been basically caused by the rising interest rates and the high levels of inflation, which actually are a direct result of some of the things that happened in the pandemic. But what we believe is that, therefore, if those are the things that have caused markets to fall, and lots of asset classes, in particular things like bonds and some things like smaller companies, for example, if it's interest rates and inflation that's caused them to fall, then hopefully we will see if those things start to get a little bit better, inflation starts to come down, rates stop going up, that actually those things could bounce. And that's sort of something we did see last week, and hopefully that's the start of a new trend. But there's no doubt that the past couple of years in portfolios has been very, very difficult because we have seen all those different asset classes all fall at the same time. And that has been particularly difficult because one of our golden rules of investing, which is that we should be well diversified and have lots of assets in lots of different asset classes, different pots if you like, hasn't really helped as much as usual. Normally when, for example, equities are falling, you would hope that bonds or property or something else in the portfolio would at least do okay, maybe even go up, and that would offset some of the falls. But that did not really help in the past couple of years. Some of our other sort of golden rules of investing is that we should normally want to put more money in cheaper asset classes and less money in expensive asset classes. We also want to invest where the growth is. So we want to make sure we're exposed to, for example, smaller companies rather than just large companies, because they tend to grow more over the long term, or emerging markets where there's higher levels of economic growth. And there's all sorts of academic research that's been produced over many, many decades that we can use to sort of rely on to make those sorts of investment decisions. And those are golden rules that we will always keep coming back to whenever we're trying to decide where to invest your money. But as I said, some of those golden rules haven't really helped us in the last couple of years. In fact, really this year, all you've wanted is a very concentrated portfolio of a small number of companies in one country, in one sector of the market, in one currency. Basically, you wanted very large US mega cap tech stocks. That's the only place that's really made much money this year. And that is completely contrary to all those golden rules I went through. Diversified, lots of different assets, smaller companies, all those sorts of things. So should we change things based on what's happened? Well, we don't believe so. And that's because we basically believe that capitalism works over the long term. It's not perfect by any means, but capitalism works. So if, for example, if you're a bank and you have to offer 5% on deposit in order to get people to deposit their money with you, then clearly you're going to want to earn more than that for lending people money. Maybe on unsecured loans it might be 7%, might be a bit less than that on a mortgage. On a credit card it's probably more like 17%. So higher levels of interest rates on cash mean that naturally we should be able to, or banks or lenders should be able to make more money by lending money. And that's why bonds look really attractive at the moment, because we can get a higher return, or a higher yield at least, from lending people money by buying a bond rather than putting our money in cash. And over the long term, if you think that you have to pay 6% on a bond in order to attract some people to lend you money, then if you are issuing equity, you need to offer an even higher potential return. So you need to be at double digit perhaps in terms of potential returns. So over the long term, what you see is bonds have always outperformed cash, equities have always outperformed bonds, and we think that will continue. Capitalism works. We think that over the long term, poor companies end up going bust and good ones prosper, and that's another reason why we think small companies tend to do better than large ones over the long term. So we'll stick to those golden rules we have. We think they're eminently sensible. They're informed by decades of research. Now, they might not have worked quite as well in the past year or two, but that's because we've been through such an extraordinary situation with inflation and interest rates. And as those things seem to be going back to something a little bit more like normality, then we believe those golden rules will reassert themselves and we can rely on them for the future as well. So thanks very much. See you next time.